And yeah, so here we are, guys. Thank you very much for joining us. This is our first investing webinar that we've done and we've put on. This has been due to a number of conversations that we have with clients on pretty much on a daily basis. And obviously, because of that, we cover a lot of the same information over and over. And what we wanted to do is take this opportunity to answer some of those questions in a bit more detail and share some of those regular questions that we have. So bear with me, I've got a couple more people just wanting to come in. Just adding those in now. So bear with me, guys. I'll try and add people in as they come in. But other than that, here we go. So this is about momentum investing and how you can build a 7-figure net wealth and a 6-figure income. So like I said just now, we've put this webinar on because due to all of these different conversations that we have on a daily basis, we've kind of identified 3 different areas where property investors have issues with at some point during that process. So what the aim is to try and help you get closer to your goals. And these are the different topics that we're going to cover today and the items that you're going to learn. So can I just ask you guys just to make sure you're on mute, if you don't mind, please? Hopefully, sorry, I'm just make sure everyone is. Okay, I think that's everyone. So why to consider momentum investing over traditional investing? Why property investing as our main vehicle? The 3 C's of investing. Momentum investing in action. Using the Hamlet Challenge. And how finance works. So hopefully that just gives you a bit of a flavour of what's upcoming. Like I said, just a bit of housekeeping, like I mentioned earlier. Still got a couple of people in. Keep yourself on mute. What we're going to do is, if you've got any questions, you can put them in the chat box as they come up, and then we can answer those. Hopefully, as we go through the presentation, but also at the end we'll have a set time for Q&A. And yeah, so who are we? So I'm Gareth Morgan, one of the owners of Prime Property Finance. I've been a mortgage broker for over 15 years, started off predominantly in the residential mortgage space, and then did more and more with investors, watched them grow, build their property portfolios and help them do it, and then decided that I wanted to do it for myself. So then started investing back in 2014. I've done most types of property investment, from buy-to-let, HMO, serviced accommodation, blocks of flats, commercial conversions. So I've got a pretty good range of personal investing experience, and also so it gives us, in terms of deal structure, I've done lots of different types of creative finance deals, and yeah, hopefully when talking with you and talking through your deals, we've got a good handle on it from an experience point of view. And also I've been doing more and more property speaking now, helping people get educated on the different financing options and different types of property investing that can be done. So that's me. Enough about me. I'll just ask Mark to quickly introduce himself. Mark?
Yeah, evening, guys. Echo what Gareth said. Thank you very much for joining us. Looking forward to sharing some of this content with you. So my background then, as it says there, 25 years in banking, specifically commercial banking, dealt with a plethora of different clients, deal structures, etc., trading entities through to complex property. And then working in the world now of specialist finance, specifically property finance for well over 5 years, specifically in this area. And also the founder of a PropTech, Pintech.io, which is a digital property assistant designed to help landlords better manage their portfolios. So that's a bit about me. Thank you.
Thank you, Mark. Okay, so what is momentum investing? Momentum investing is about buying assets that have potential of going up in value, rather either via a rising market or by adding value. So I'm guessing that you've joined us today because you have an interest in property. Whether that's wanting to get into property investing, or whether you're already an investor and want to learn more about the financing options. So traditionally, momentum investing would just be buying a property in an area, well, one in a rising market, which we've had a couple of those over the last couple of decades, but we're certainly not in a fast growing market at the moment. So it's definitely not that. Or invest in an area which has got the potential for good upside because maybe there's some big news and a big factory's been built, maybe like HS2. If you bought around the HS2 area, you're foreseeing that because of those better transfer links, that property is going to go up in value. So buying in a rising market, or by adding value of some sort, which is probably what we're going to talk about more today, and how you can add value, recycle your funds, and then allowing you to gain momentum and improve your investing returns over the long run. So what is momentum investing? So traditional investing versus momentum investing. So traditional investing is either starting from scratch and saving through your regular monthly income, or you might have a pot that you've started with, maybe an inheritance, so you've got some savings, and you now decide that you want to invest that. So you can invest that in any sort of asset class. That could be cash, could be bonds, stock market, or property. But the traditional method of investing is you invest what you have, and then you just have to wait for that to grow over time, hopefully. And hopefully the returns you're getting are better than what inflation gets as well. So you can only, the theory is that you can only invest the funds that you've got to invest, okay? In regards to momentum investing, if it's done properly, it allows you to lock in a lot more growth early on into your investing journey and your pot, and that will have a huge impact on your net wealth over time. So sorry, there's just someone trying to get in. Okay. So why property? So for us, we believe property is the best investment vehicle for your investments. It's more hands-on than other property investment types. However, the benefits are narrowed down to these 5 areas we believe is the reasons that people would be better off investing in property than in other assets. So a really, really big one is the ability to use other people's money. You may be sitting here thinking that I want to get into property, but I don't have the cash. But there are a number of ways that you can structure property deals by using other people's money. You can't really do this in the stock market. You could borrow money from someone to invest in the stock market, but it is very risky. So at least with property, there is the ability to do that if you don't have your own funds. Next up, we have social impact, and there's a housing crisis. So looking at the market of where we are at the moment, there's lots of news about the mass shortage of housing stock available in the UK. Some landlords are actually leaving the market due to changes in the tax rules because they own property in their personal names. There's also increased regulations. However, that does provide an opportunity for new investors with young blood, etc., who are keen, they know the rules of the game, and they're ready to play. So if you're interested and you know how to play, you structure yourself properly, then you're in a really good place going forward. Also, rents are an all-time high because of the shortage, and also the new government has come in and said they've pledged to build more houses. So hopefully we'll see some loosening of planning rules, which, at the moment there's a big disparity between what the government's saying and what the actual housing, the planning departments are doing on a local level. But hopefully this government may bring some changes in. Another reason is leverage. Leverage is probably one of the biggest reasons why property is so powerful, but we'll come on to that in a little bit. Predictable, it's well known and understood. If we think about Maslow's hierarchy of needs, the first thing on that level of needs is the human need for food. After the human need for food, it's shelter. So there's always going to be a demand for property. The UK is a small island. Our population is getting bigger. And, like we mentioned earlier, the housing crisis, everybody knows what property is. If you compare that to your other asset classes, such as stocks, obviously the new one on the new trend at the moment is crypto. These are a lot of unknowns. They can be affected by the market, and so it's a lot more difficult to control and understand. So that's that. And again, just following on from that then is being able to control the outcome. Property investing on a really small scale is a lot easier to control the outcome compared to other investment vehicles. You're not as impacted, you know, if you're just doing one house at a time or a couple of houses at a time, it's a lot less at risk compared to the other. It's a lot more in your control, and it's a lot less at risk to bigger market conditions. And it's also a lot easier to do due diligence on property when you know, to find out the cost of a refurb or the end value of the property. There's so much information out there. It's a lot easier to make informed decisions. So the key sentiment really for us at this stage is, whilst there's a lot of negative news in the marketplace, if you listen to the news, and changes in legislation coming in, as long as you know the rules of the game and you are treating it like a business and you're going to run it like a business, then there's definitely an opportunity. Okay, so we talked a little bit just now about leverage, and this is probably the most powerful thing. It's a real game changer compared to other asset classes. You can use leverage in other forms of investing, but it can get quite dangerous if it's not done properly. So what we're going to give an example, and this is going to be a really simple example of, if you have £100,000 of cash or savings that you want to invest, show you the difference about how using leverage can really grow your gains. So on the left, we've got a single property. You buy a property for £100,000 and with no mortgage, and it'll rent for £750 a month. That's fine. However, you could, with the same £100,000, using a 25% deposit, buy 4 houses. Obviously, we're ignoring stamp duty and fees and everything like that. Obviously, there's lots of caveats to this, but I just want to make it nice and simple for you to understand that you could buy 4 houses, which is the smarter way to do it. You'd still get the £750 per month in rent, not mortgage, apologies. The interest-only mortgage would be £412 a month, giving you a gross profit of £338 a month. But you multiply that 338 across the 4 properties, that would give you a cash flow of 1,352. So as you can see, by using the same 100,000 pot of cash, you've just increased your income from £750 per month to £1,350 a month. So you've almost doubled your income just by spreading your funds and buying more assets. So that's where leverage can come into it. However, this is the really interesting part, is historically property prices have doubled over the last 100 years. So every 10 years, the property prices doubled. Now, you might say that hasn't happened recently. We have actually had some good growth in the last couple of years, but maybe not doubled in value. But on average, even if we said they didn't double in 10 years, they doubled over 20 years, I'll show you the impact that that could have. So if you buy one property with 100,000, if that property is empty at that time, you will lose 100% of your income, which isn't ideal. And obviously, if the property doubles in maybe 10 or 20 years, that single property that you own is now worth 200,000. If you buy 4 properties, and one of them is empty, then you only get a 25% reduction in your income. And obviously that means you're reducing your risk, which is really, really important. And then if we say in 10 years time, or even 20 years time, the values of those individual properties have all increased to 200,000, that gives you a total value of 800,000. Yes, you've got the mortgages on there, which are 75,000 each on an interest-only basis. You haven't paid any of them off, gives you a total of 300,000. The equity in those properties is now 500,000. So you can see the 100,000 that you started off with not only give you almost double the income from the beginning, it's now more than double the equity in the property. So by using this strategy to spread your risk and buy as many properties as you can using leverage, you can really, really improve your net wealth over time. And this isn't even using the momentum investing model that we're going to talk about in a bit more depth now. And another beauty of this is the inflationary effect of debt, the inflation effect on the debt. So those mortgages that were 75,000 each in 10, 20, 30 years time aren't going to have the same purchasing power. So that 75,000 is going to be worth a lot less in those future years. Everyone can remember a Freddo being 10p, and I don't even know what they are now. They're probably a pound, but everyone gets the sentiment of how inflation quashes debt over time. So why momentum investing as well? So we also mentioned about the ability to use other people's money. You may be sitting there thinking, well, that's great, but I haven't got 100,000 to invest. And well, the beauty of property investing is you can combine momentum investing, which we're going to talk about further on, and other people's money. You put those two together and you can really really grow your own wealth. The ability to use a single pot of funds or other people's money as a single pot of funds to fast track your portfolio. If we do the traditional method, investing through the traditional method of just saving up for a deposit, you'll see how slow it can be. So if you take the average salary in the UK at the moment, which is a bit higher than I actually thought it would be, of 35,830, and you're able to save 10% of your salary per year, it would take you 10.5 years to save a 25% deposit on a £150,000 house. So if you could imagine, you want to buy property, but you have to wait 10 years before you can buy it. And then you'd have to wait another 10 years. So it's quite a long time before you can get, and you're going to miss out on a lot of momentum in that time frame. So hopefully this just illustrates how difficult it is to invest in this manner, and why using your funds wisely or partnering with somebody else who has money is a really good idea. So then it's all about learning how we go about doing it. But before we go on to the how we do it, I think it's really important that you understand your own why, because a lot of people get into this and they need to understand the reasons you're doing it. Property investing isn't easy. We are definitely not here to tell you that property investing is get rich quick, because we're definitely not saying that. Investing isn't easy. It's a lot more hands-on than other investment types and classes. However, using other people's money and momentum and leverage, you can really get some compounded growth over time. So what the key principle for us is, start with the end in mind, understand where you want to go, and then it's a lot easier to get there. So these are generally the conversations that we have as to why people are trying to get into property to do more. Is it because they want more time on their hands, so they can maybe lose a day of work? They might want to lose work altogether and quit their 9 to 5. They might want to fire their boss, which would be a great position to be in. It might just be that they don't want more time now. They're happy, they really enjoy the job, but they want to build a better retirement for the future. They might want to retire not at 68, because by the time they get to retirement age, the government's moved that pension age on further again. And it might just be to do more nice things with the family. So whatever it is for you, you need to decide what that is, so that you've got really clear moving forward. And then once you've figured out why you're doing it, then you also want to figure out what it is you're trying to achieve, because the amount of conversations that we have are just with people who just say, oh, I want 10 houses, I want £10,000 a month. Where have those figures come from? They are just arbitrary numbers that sound nice, but actually, have you spent the time working out exactly where you are now and where you want to be? And then you can it's a lot easier once you know where you want to get to put a plan in place to get there. So if you want to quit your job yesterday because you really, really don't want to do it anymore, compared to someone who loves their job and wants a pension pot, Those are two very different plans that you'd have to invest in property and how you'd go about doing it. So once you're clear on where you're going, then you just need to be prepared. So what we've done is we've developed the 3 C's of momentum investing. And that's clarity, confidence, and credibility. So clarity is all about knowing where you're going and why, having a really clear investing strategy and criteria and knowing your numbers. So we've just talked about your why. Why are you doing this? You need to get clear on your strategy, and obviously where you want to be, why you want to do it will help you perform that strategy. Are you going for income? Are you going for long-term planning? So depending on that strategy will then help you know your numbers when it comes to assessing what type of property you're going to go for and what those deals look like. So once you've got clarity, then you need confidence. So you don't want to be a motivated buyer. You want to be able to walk away if the deal doesn't work. You want to have self-belief, law of attraction, big believer in law of attraction. So if you've got self-belief and you're expressing that into the world, then you will have not only your own confidence, but other people will have confidence in you, your ability to deliver the deal. And a super important one is focus. So not wasting time on deals that are never going to work and moving quickly onto the ones that do. A lot of people who invest in property are not doing it full time, and they're doing it amongst, they're part-time amongst their jobs. So because you only have a limited amount of time to invest, you don't want to, you want to limit how much time you're wasting on it. So you need real clear focus on what you're doing. And then once you've got clarity and confidence, you have what you need then is credibility. So once you're going to vendors or estate agents, as you build in those relationships, they want to know that you are credible, because if they're going to pass you a deal off market, or if you're dealing with a vendor direct, that they believe that you can carry out the transaction. They will sense that from your own self-belief and confidence. It's about not being that motivated buyer. You want to know, these are my numbers, this is my offer, and be able to walk away. And that all becomes knowing your numbers and having the right strategy. Okay, so moving on to the holy grail of momentum investing. So my philosophy has always been around having the ability to get all of your money out of a deal. If you can take a pot of cash, buy a property, do it up, refinance it, and pull all of your money back out, you've got a free property and you've got your pot of funds that you started with, and you can do it again. And you just rinse and repeat that process over and over. Now, I speak to a lot of people who don't actually believe that you can get money out of deals, all your money out. I'm telling you, you can. I've done it myself. Lots of our clients have done it. We've done deals where we've actually had some cash out. And there's plenty of examples out there of people who've had a lot of cash out of deals as well. So it can definitely be done. And once you realize that they are out there and it can be done, then you've got to realize that everyone is after them. You're not the only person that's looking for these deals. These deals don't hang around for long. So you need to be prepared. And I think that's where, what we talked about here is being primed and ready. So you have all your figures in place, you're ready to go, so that when the right deal comes up, you can jump on it, because they don't hang around long. And what I said about having a criteria, knowing that because not all deals will be money out, they're not to a penny, you need to understand that if there's a deal that doesn't quite stack and there's money left in, where does that fit into your criteria, and is it one that you would still go for? Everyone's different. It's making sure you understand your own game. So what we are talking about, like I mentioned earlier, we are talking mainly about buy, refurbish, refinance in the property sector. So or buy, refurbish and flip. It's not always refinance. Some people don't want to be landlords. They just want to flip deals on for profit. So what we're trying to find are properties that are suitable for this type of strategy. So they generally are auction properties. A lot of these will sit within that. So probate, repossessions, unmortgageable properties and short leases. A lot of those will sit within auctions, but you can find those deals outside of auctions. You might see property that's got potential, you know, in some places in London. We had a client the other day who had found a big 1-bed flat. He carved it up, made it into a 2-bed flat, and he had great gains on that property just from doing a little bit of internal work. So it doesn't have to be unmortgageable properties that suits the strategy. It can just be properties where you have identified that are tired. It's the worst house on the best street. It's tired. It just needs some TLC, and you can get really good gains from that. So it's identifying where you can add value. So there are lots of different ways to add value, but generally it's through either refurb or an uplift with planning. So how does it work in practice? So there's 2 types of finance available. So the one that most people know is long-term finance, which is your standard mortgages. So that can be a residential mortgage, a buy-to-let, HMO, serviced accommodation, commercial, semi-commercial. So all these are mortgages effectively, but they're different types of mortgages depending on the end use. Lots of people actually do buy, refurbish, refinance deals for their own home, and they keep doing that and flipping those on because it's tax-free profit as well, which is excellent. And then the other type of finance is short-term finance. Now, if we're looking for properties which are unmortgageable, then obviously we can't use a mortgage on it. But there are some deals that you may find that are mortgageable, where you can buy it on a buy-to-let mortgage, do some light renovations, like the example with the apartment, where you could convert a 1-bed into a 2-bed, and then you could go to a mortgage lender and they could offer you a further advance on the existing loan. So you wouldn't actually have to refinance away to another lender. So that's something that's a little tip where we have lots of investors and clients of ours that don't even realize that they can do that. So that's a really good tip, taking a lender that allow a further advance. Properties that are unmortgageable, then we're looking at the short-term finance. So first one is cash, obviously your own cash or other people's cash. You might have property equity in your home. You might have equity in your portfolio, bridging finance, personal loans and credit cards. I'm always very wary of advising or discussing using personal loans or credit cards for your deals because it could catch you out when you come to refinance, because it can affect your credit rating. So if you can, try and use funds outside of your personal credit, because looking after your credit report is one of the most important things you can do. And it's not just within investing, just in general life. Life is so much easier when you've got a good credit report. So if you don't know what your credit report is, if you've never checked it, then I urge you to get that checked out. Again, another tip, just make sure that I think it's about 1/3 of credit reports have mistakes on them. So it's really super important that if you haven't got it, go and get it checked out. So yeah, cash, bridging and other investors' funds are the types of finance that we can use. So what we're going to focus on today is on bridging loan. Whilst cash is king, and if you've got your own cash, then that's great. However, that does come with risks. If you are buying with cash, I've seen so many people do it. They've bought a property at auction with cash. They've done very little due diligence. They haven't checked the legal pack, alarmingly. They haven't had a valuation done. They haven't had anything sense checked. So they end up in hot water. And so using a broker and a bridging loan or a bridging company, for instance, your deal is going to get sense checked by your broker. It's before it even gets to a lender. Then the lender is going to sense check it and underwrite it. Their valuer is going to value the property to say whether it's worth what you think it's going to be worth at the end. And obviously the legals, the lender's legals, solicitors are going to check it as well and sense check it. So there's a number of layers of protection you're going to get by using a firm. And then in terms of investor relations, so you know, advice would always be, if you can buy in cash, if you've got cash, buy in cash, but make sure you put enough necessary steps in to protect yourself. In regards to investor relations, if you're using private investment, you also are at risk of how that relationship is with the investor. If you've just found an absolutely brilliant deal and you need to move quickly, and your investors agreed with you, and then all of a sudden your investor turns around and says, oh, actually, I've had a change of heart. I've just found out my daughter's getting married, or my daughter's pregnant, or something's come up, and that money's not available to you, you may lose credibility with the agent or the vendor, and you might lose the deal, and you might mess up that relationship. So you must be careful when using investor funds. And then, ultimately, bridging is a business. Bridging loans and lenders, their job is to get money out the door. And so they won't let you down. If they say they're going to lend, as long as the valuation stacks and everything else falls into place, they do want to lend you money. Okay. So what we're going to do now is just going to run through, how this works in reality, taking you through the BRR model, the buy, refurbish, refinance. I'm not a builder. Obviously, I've done plenty of refurbs, but I'm not going to talk about how you assess the refurb or anything like that. I'm just going to put a cost to it. I'm not going to talk about, of course, how to source deals. This is on the basis that you are finding the deals yourselves. And then you come into us and say, right, we found a deal. We now want to assess whether it can be done and what the numbers look like. Excuse me. So this is an example of a purchase. So what we're saying here is that the purchase price is 200,000. In generic terms, there's lots of caveats here, but in generic terms, bridging lenders will lend 70% of the purchase price, which means you need to put in a deposit of 30%, which is 60,000. The lender will lend you 70% of the purchase price, and this is called the gross loan. Again, generically, bridging companies charge 1% per month of the gross loan. So that's 1% of the 140,000, which is £1,400 per month. And what we're saying is that by the time we want this loan for 12 months. So by the time we buy it, get the keys in our hands, get the builders in there, do the renovation. Then once the renovation's done, we go through the remortgage process, get the valuer out, get it tenanted, and go through the legal process. We want to make sure we've got enough time to be able to pay this loan back. So we've gone for a 12-month loan. So what the lender does, so that you haven't got any monthly payments, they deduct all of the interest off you up front as a cost. So there's no monthly payments in this example. We'll talk about the different types of interest that bridging lenders charge. Those three are serviced interest, retained interest, and rolled interest. This is retained interest, so they're retaining all of the interest from you on day one. Okay. Lenders then charge an arrangement fee. This generally is 2% of the gross loan. Brokers usually charge about 1% of the gross loan. So in this example, that's 1,400. We charge a fixed fee, but different brokers charge different fees. And then the legal fees and the valuation fees. So one really key thing to learn here, again, this point gets missed quite a lot. If you are using bridging finance, not only will you pay your own solicitor, but you would also pay for the bridging solicitors as well. So you'll see the figures here. And also that's based on the property value. And they will instruct their own valuer to value the property in its current condition. And they'll also value it in the end condition once you've done what you said you're going to do to the property. So they just want comfort that what they're lending and securing their loan against is of value. So those will vary. So the total costs there come in at 24,000, and all of those get deducted from the gross loan, which leaves you with a net loan of 116,000. Okay, so we've got 70%, which is the gross loan. The lender then deducts the interest and the arrangement fees and the legal fees, and then you're left with the net loan, which is what you get on the day of completion. So just to round up, if you were buying this property at 200,000, the total cash you would need to purchase this property is £60,000 deposit, which is the 30%, the 24,000 in the costs. I've not included stamp duty here because in different parts of the country and different types of deals, they vary. If the property is unmortgageable, you might not pay stamp duty at all. So that's a separate conversation we're not going to cover tonight. So the total costs there are 84,000. And on this particular example, the renovation is 45,000. So that leaves you with a total cash input for this deal of £129,000. So the total spend altogether is the purchase price of 200,000, the cost of 24,000, and then the refurbishment costs of 45, give you a total spend of 269. So the total cash needed for your input is 129, but the total spend is 269. So what we look at then, at this point, we purchased the property, we've done the renovation, now we're looking at the refinance and how that looks. So what we've got here is the end value, or sometimes you'll hear this called GDV, which is the gross development value. So that we're saying that's 350,000 now that we've done the work. And what a mortgage company will then lend you is 75% of the end value. So 75% of the end value is 262.5. And what we said on the previous slide is that the total spend for us was £269,000. So that means if we've only got 262,000 from the mortgage, we've left £6,500 in the deal. I think there should be a 500 in there, but it's slightly out. Apologies. So there's £6,500 left in the deal. However, this property is going to rent for £2,000 a month. So it's not quite been an all money out deal, but it's not a bad deal at all. So leaving £6,500, we'll go on to explain a little bit more about that in a second. And this is giving us a gross yield of 6.86%, which is the annual rent divided by the property value. Personally, I don't particularly look at gross yield as part of my investing criteria. I'm more interested about return on cash employed, or ROCE, which we'll touch on in a second. So two things to note here is when you apply for the remortgage, the valuer, so we'd have to put in what we think the property is going to be valued at, what the rental income is going to be. And the valuer then, when they go out, they're going to say, yes, it is now worth 350,000. So that's great. Yes, we agree the rent is going to be 2,000, but they will also, there's a third part which they will also comment on, is whether there's enough demand for that property in that or enough rental demand for that property in that location. So there's quite a lot going on this slide, so I'll just walk you through it nice and slow so you fully see it. This is what we do as brokers to check when it comes to the long-term mortgage, because to check whether it's a viable deal for you or not. So when you go out to the bridging loan is relatively easy to get, but there's no point getting the bridging loan if you don't know you can get the remortgage to pay back the bridging loan at the end of it. Okay, because bridging can get expensive if you're left on it for a long time. So it is short-term finance for a reason. You want to be in and back out. The lenders don't want you on it for a long time. They want to recycle their money and move on to another deal. So what we have here is the 75% loan, and this is called the interest cover ratio, or ICR for short. And what this means is that lenders will do a stress test to see that your loan is affordable should the interest rate increase in the future. Now, over the last 12 to 18 months, we've actually been in an environment of increasing interest rates, and some people have been caught out by this because they took out deals back when the interest rate was 2% or 2.5% or 3%, and now they're more like 5.5%. So some people have actually been caught out by this. So it's really careful that not to under stress your deals so that you know that you can repay the bridging loan. So how does this work? So what lenders do is they will use a stress test. So in this example, they're using 7%. So they will times the loan amount, which is the 262,500. They times that by 7%. So if the interest rate went up to 7% in the future, you could still afford the mortgage. That gives you an annual interest of 18,375. We divide that by 12 to get the monthly figure, which is 1,531. And then they add an additional percentage increase on this called the debt service ratio cover, which is a mouthful. But what they do is they add 0.25% or 125% on top of this, because even though you've got the mortgage payment to make, you've still got buildings insurance, you've still got annual gas and electric testing and some maintenance. And if you've got voids, there'll be some holding costs, etc. So they want to know that you can still make the payment and those additional costs on top if the interest rate goes up. So in this example, the 1531 of the monthly interest stress test, we times that by 125%, and that gives us a figure of £1,914. So your rent that you're going to get on this property needs to be more than the stress test figure. So you can see there, our rent is going to be £2,000 a month, which is more than the stress test figure, which means you've passed the stress test, which means the lender would be happy to lend. If, like I said earlier, when the valuer goes out to the property and they come back and they say, well, actually, we don't agree with your valuation of £2,000 a month. We believe that this property would only fetch in the current market £1,800 a month. That doesn't mean that they won't lend to you still. It just means they will reduce the amount of money that they'll be prepared to lend. So the stress test would just come down, and you'd have to, until that gets to it, you'd reduce the loan amount until the stress test comes down to 1,800. So they will still lend, but they will reduce the loan amount. So you need to be aware of those. And like I said there, this is a stress test based on a 2-year fixed rate, which is 7%. However, lenders, if you take a 5-year fixed rate, will lend you based on the pay rate of the loan, which means they will stress test it lower. So if you did want a 2-year fixed rate, but you couldn't quite get enough of a loan size, you could go for a 5-year fixed rate, which may give you that bigger loan that you need. Okay, it is a little bit complex. It doesn't need to be that complex. There's a lot of different figures out there, but all you need to know is, am I protected should the interest rate go up to a certain level in the future? And you would want to stress test that yourself anyway, because if you are going to buy this property, you're going to own it for the next 20, 30, 40 years, you want to know that you're protected, that the rent that you're going to receive is going to be more than your mortgage payment. So just then taking this example one step further, whilst that's the stress test on this deal, it's not actually what you'd pay. So take the 262,500 and using an interest rate at the moment in the market, it's about middle of the road. You can get slightly cheaper rates, but that will have a higher arrangement fee, or you can get something closer to 6% with no arrangement fees. So I've just used a middle of the ground figure of 5.44%, which gives you an annual interest rate of 14,280. Divide that by 12, gives you monthly interest of 1190, which gives you, once you take that away from your £2,000 a month rent, that gives you £810 a month in gross cash flow. And you times that by 12, that gives you an annual cash flow of 9,720. And this is the calculation that I like to use, is the return on cash employed, like I mentioned earlier. So this is your cash flow divided by the money left in. So the £810 a month divided by the 6,500 that you've left in means that you'll get all of your money back within 6 months. So not only have you got a property that's now worth 350,000, it's got just under just under £90,000 worth of equity in there, the 25% equity, and it's giving you £810 a month in cash flow. So you've just created in this one deal, you've created over £80,000 worth of equity, which is in your net wealth, and it's giving you £9,000 a year in additional income. If you did one of these deals a year for the next 10 years, you could see how you could really, really grow your net wealth. So slow and steady wins the race. You could just do one of these over a long period, and everyone's got the ability to do one deal a year. And the point we're making is that we get it often that bridging finance is expensive. And yes, it can be expensive compared to a mortgage, but they are different products. They aren't, you're not comparing apples with apples. If you can't get a mortgage on a property because it's unmortgageable, then you can't compare it with a mortgage because you can't get a mortgage. So the point being, yes, it's expensive, but it's only expensive for a short period of time, and it's a cost of doing business. So hopefully that's been helpful in understanding how buy, refurbish, refinance works from a finance perspective. If you have got any questions, please put them in the chat box. We will come to them in a bit, but please put them in there and we'll answer as many questions as we can a little bit later on. I'm conscious of time, so I want to move on. So the theory, what we're saying here is having the clarity on your numbers. So being able to know these numbers so that when you're assessing deals, you know if it's a good deal for you or not. What I mentioned really, really early on this bridging deal, not sure if you can see my cursor there, but on that, where I said it was going to be 12 months worth of interest at £1,400 a month, if that deal, if you manage to buy this property, refurb it and refinance it within 6 months, you're going to save £8,000, £8,400 in interest to the bridging company, because they will only charge you for what you use. So if you do this deal in 6 months, you save £8,400 in interest. All of a sudden, the £6,500 hasn't been left in this deal. You will have actually had money out, just over £1,000 out. So this would have been an all money out deal. So I want you to know that these all money out deals are there. I've mentioned that already, but the ability to find these is difficult. So if you know that you can get all of your money back out after 6 months, then that is still a good deal. Now, one of my best mates, he's an investor as well. His philosophy is different to mine. He is happy to leave more money in a deal. So his return on investment is he's happy to have a return on cash employed of 25%, which means if he can buy a property this year and he gets 25% of the money of his cash back this year, and it takes him 4 years to get that back, he knows that he can keep buying properties like that. And over time, that's going to add huge amounts to his net wealth. So his philosophy and mine are completely different, but that's because of our personal circumstances. So if you've got any questions on that, please do drop them in the box, like I said. So once you know the theory and the numbers about what type of deals you're looking for, what we want to be able to do, like I mentioned earlier, you haven't got a huge amount of time to do this unless you've got other people finding deals for you. So if you're looking for deals, what you want to be able to do is move the deals on that are never going to work quite quickly. So this is where we use something called the Hamlet Challenge, and this is how much should you pay for a property. Okay, people ask me all the time, is that good? Is that a good price? I don't know. I don't know the area. You need to know your area inside out. So this comes from back in the day, the Hamlet Challenge. I don't know if anyone has ever actually seen a packet of Hamlet cigars, but this was what they used to do in the pub before they had phones and technology and there was no bits of paper lying around. You take the sleeve off the Hamlet packet and it leaves you a little bit of card this big, and you could write these numbers on this card. And if you can't do this a deal on the card, then it's probably not a good deal. Or if you want to work out quickly what to offer on a property. So what we start with the end in mind. So we start, the first line on the paper would be the GDV, or the end value. What's this property going to be worth once I've finished the work? So we're going to say it's going to be worth 200,000. We take 75% of that because we know that that's what we can get on the mortgage once we've done the work. So that will be 150,000. In this example, we're saying that the refurb cost is going to be 40,000. And we know now, having done some examples about what our finance costs are going to be, our solicitors' costs, our stamp duty, our valuation costs, etc. We know all our costs are going to say, call it 10,000. So when you deduct those away, that leaves you with your offer price. Now, for this deal to work for an all money out transaction, then it needs to be close to 100,000 asking price. If you can get a deal to work at anywhere close to 100,000 here, then you know that's a good deal, because even if you have to leave some money in, it won't be that long until you get those numbers back. So hopefully that's clear. Again, if you've got any questions on the Hamnet challenge and what that looks like, please, again, put them in the comments. And that's me done for now. I'm going to hand over to Mark, and he's going to just come in and share some points of his own. Over to you, Mark.
Yeah, thanks, Gareth. Really appreciate it. Yeah, so what we want to do is just have a quick chat around. So we've gone around the principle of momentum investing, in particular the buy, refurb, refinance, made reference to bridging finance. Just thought it useful just to learn through some of the mechanics and some of the things you need to be aware of when considering either using bridging finance or indeed refurbishment finance. They are actually two different products. So we just want to highlight to you the differences between the two, some of the benefits of using one over the other, but also some of the negatives that come along with it as well, and some of the ways that you can, if you're not aware, actually find yourselves being possibly slightly caught out. So as that example showed, the number of numbers that were on the page were because buy-to-let mortgages have two basic principles. You run it on a loan-to-value basis, so that is literally what is the asset worth versus the maximum LTV that lender will lend. And the other element to that then is the actual affordability. Can the income service the mortgage payments per that example? Bridging, however, is half of that. So bridging focuses purely on the loan-to-value. So what is the asset worth and how much are you looking to borrow? Okay, so we don't really have to get into the affordability. It can rear its head if you choose a certain strategy or you choose a certain type of interest. But I'd say 95% of the transactions that we do, affordability is not part of the equation. Okay, so the loan to value will differ depending on, so you can use bridging across residential, commercial, mixed use properties, so where you've got a shop on the ground floor and residential apartments or flats above. You can use bridging for almost any property type. What the lender will do, however, is alter the loan to value they are prepared to lend on that particular property type. So residential, you'll get your higher LTVs, even as high as 85% in some instances. For below market value deals, there are actually products out there that will go up to 90% of the purchase price. Where you step into mixed use, the risk profile is greater. So yes, we've got the residential element upstairs, if you like, but you've also got then the commercial. Commercial adds a different dynamic to property. We all know, as Gareth mentioned, people need houses. Not everybody needs a shop. So we just need to measure that demand. So you'll find then that that'll be the mid range for the loan to value. So that'll be sort of your 65 to 70%, that sort of figure. And then when you go into pure commercial, that is very much driven. Commercial as a whole is its own category. And you have differing loan to values based on the type of commercial property. So for example, if it would have been office space through lockdown, you'd have really struggled because offices weren't being used. There was no demand for that type of property in commercial. If you were, however, using light industrial units for storage, you could have probably got some very high LTVs in there because of demand. Commercial, that demand changes all of the time based on what's going on in the economy. Okay. And as Gareth mentioned earlier, there are two types of interest. So there was actually three, but there are two that we use more often than not. and two that I'll focus on to demonstrate a point for you, really. So interest can be retained from the outset, or it can actually be serviced. So we've got an example here as to why, or you may decide to do one over the other.
How to spot ADHD in women? Because the hyperactivity is in their heads.
Can I just ask if people can mute their...
And it never stops, ever.
Sorry,
This causes a lot of anxiety, which is...
Seconds. Just muted you now, Matt.
Okay, you did me as well, thank you.
Sorry.
Sorry. Yeah, so on this then, so there's two different models here. Okay, so we've got the retained, which is, I would say, the most popular. But from time to time, we will use a service model, and there's a reason why we will do that. And the reason being is that what you will get on day one, so there are two figures to be concerned about, is the gross loan, and then you have a net loan. So the gross loan is what the LTV is based on. So in this particular example, you pay, the property's 200,000, you get a 75% loan to value loan. So that's 150. Now that is the gross figure. In the retained model, you would deduct all of the costs that exist. So your interest rate per month, your arrangement fees, etc. And that actually brings you down to the net loan advance in that one is 121,000. Now, the benefit of that is that you don't have to find any money throughout the life of the loan, and you can concentrate on just developing the property or doing whatever it is that you intend on doing with it. However, your day one contribution, as you can see in that particular instance, is £84,750. So that's how much you would have to contribute to the purchase of that particular property, taking into consideration some stamp duty, valuation fees, and other costs. Now, on the service element, okay, exactly the same purchase, gross loan, loan to value, interest rates. However, this time you're going to be paying on a monthly basis the payments. There is no fee to deduct, or there is no interest to deduct, rather. And that will then mean you have a net loan advance of 154,000. This does mean you have monthly payments of £1,500. You still have your stamp duty and your valuation fees. So your contribution on day one is now 51,750. So we do use this in instances where people have strong income, either through their property portfolio or they have healthy salaries or disposable incomes. But they are perhaps absent of the amount of cash required to contribute to the transaction. Okay. However, the service does come with quite a hefty serviceability assessment, affordability assessment, and it's akin to a mortgage. So it is a longer process to actually get the loan as well. So that's something to bear in mind. So very, very often we go down the retained model. It's the most straightforward. Doesn't mean you have to find the money on a monthly basis, and everything's factored into it. And as Gareth said, if you didn't borrow this money for the full 12 months, how it actually works is the amount that you are due to pay back is 150,000 at the 12-month mark on its anniversary. If you paid this off in 12 months, you just get a redemption statement, which will not be 150. It would be reassessed and accounted for on that basis. Thank you, Gareth. Next slide. So that's the difference between those two, the two main types of interest. Now, a huge topic is, I've said that this is an asset, this is an LTV-based product and an LTV-based assessment. So a huge part of this is the valuation process. And not many people understand that there are different types of valuations depending on the lender. The lenders are very clever in the way that they market their rates, and they will make some quite bold claims about the LTVs that they will lend, etc. And this is really explaining to you how they are able to do that and still price competitively. However, when you get to the end of the process, you start to wonder why you didn't get as much as you thought you were going to get at the end of the process. So the three principal valuation methods that will be asked for. One is the open market value. That is probably the value you are most familiar with. So that is, if it was allowed to sit on the market forever and a day at a set price, what would the market demand be for that? And what would the market value be? So that would be something that the agent would, if you spoke to an agent and asked for their opinion, they would probably be close to this open market value. Then we have the 90-day value and the 180-day value. I'll start with the 180-day value. So this is on the, sorry, the heading's the wrong way around. The 180-day value, we ask the same question: what is this property worth? However, what if we need to sell that property within 6 months? So we now have a time pressure on this. So we don't have the ever-ending timescale. We're now forcing to sell that in 6 months. So what we would have to do, typically that means you'll get a discount on the purchase, on the value of between 10 and 15% below the open market value. And then the same is exactly the same for the 90-day value. That's even more aggressive. So what if we need to sell this property within 90 days? How much do we need to take that off? So that is then saying we'll take another 10 or 15% off the 180-day value. Okay. It is really important to note on this point that we are talking about something called the vacant possession value. Some of you may be familiar with commercial values, etc. This is not what that is about. Bridging is an asset-based and empty bricks and mortar-based valuation method, and it's purely on the vacant possession. We only talk about commercial valuations when it comes to the mortgage. Okay, so just want to highlight that for you. So we've got to work an example of this just to bring it to life, to give you a demonstration on that. So the same figure, okay, so we've got the open market value, okay, property value is 20, so this is the same LTV. So this lender is telling you they'll do 75% loan to value, but 3 different lenders are using 3 different valuation methods. So the open market value is 200. At 75% of that, you'll get 150,000 as your open market value. 10% deduction because of the 180-day limit will give you a property value of 180,000. Your 75% is considerably less. It's now 135,000. And bearing in mind, these are gross figures, so you've got to deduct all the costs as well out of this. And then we go down to the 90-day value. So that's now, they're coming back with 160,000 as they figure, because that's less than the 180-day. So you've now got a 75% figure, means that your gross loan, your starting point before you deduct costs, is now 120,000. Okay. There are lenders that do lend on the 90-day value, but will claim that they will lend 85%. So you can see how they can play with the numbers and manipulate it to make them look really attractive. However, you've paid for your valuation costs, you've probably paid for multiple fees to get into that position in the first instance, not understanding the valuation methodology, and you could end up with quite a nasty surprise at the end of it, and nowhere near the figure that you need to make that deal work. So it's so important that you understand this element to it. Thank you, Gav. The same principle applies to refurb finance. So I'm not sure if many of you are aware. So we talk about bridging. Bridging is really it's focused on the purchase of a property, usually, unless you're using it to refinance an existing. So we're focusing on the purchase element here. But you can actually get funding to support you on the refurbishment costs as well. Okay. So this is a way that we help clients to get more money out of a transaction by sharing a few different things with a lender and structuring it ever so slightly differently. Okay, so this refurbishment finance assists in both the purchase and the build or refurbishment costs. Still a short-term facility. Refurb finance, you really wouldn't be keeping this for anything longer than 12 months. You can go to 18 and 24, but that's reserved for quite complex developments. The build costs are drawn down in tranches, so you'd only pay for what you're using as you go through the process. Now, this is really important as well when it comes to refurb finance. The build cost tranches are paid in arrears. So let's assume this was £50,000 worth of refurb costs, and you were going to take 5 individual drawdowns at £10,000 each. You have to pay the first 10,000 to unlock the next 10,000. So in addition to your purchase funds, you need to have capital to cash flow the deal in the first place. Now, you may also require something called monitoring fees, or asset managers may come out and want to see. And the reason for that is if they're going to lend you the money to do the build, they want to make sure that the build is actually progressing. I did work in HSBC for a number of years, and I do know that they did lend money to somebody to build a house. And when they went to check it 5 years later, it was still a pile of bricks and the money had gone. So monitoring surveys are a key part of tracking that property is on course to be what it's meant to be. Thank you. So refurbishment finance, how much can I borrow and what are the costs? bridging is just LTV. What's the asset value? What's the LTV? And we touched upon that. There are more considerations around refurbishment finance. So the two that I want to focus on are something called a loan to cost and a loan to GDV, or a loan to gross development value. Now, this sounds super complicated, but it really isn't. Loan to cost is simply what's the purchase price of the property, what's the build cost, add those two figures together, and they will tell you what the max percentage is going to be. Okay, usually 80% of the loan to cost. The loan to GDV, so that's the end loan to value, they will give you that figure. That's usually 65%. So on your project, you simply work out those two numbers, and whichever is the lowest will be what the maximum loan will be for that lender. Again, we're talking in gross figures, but that's how simple it is to work it out. So it's not overly complicated at all. Now, we've made a note on here on additional security. There is the ability, if you don't have cash to contribute to your transaction, but you have other assets, i.e. property assets that have equity in them, we can do something called a quasi-stake, but it's basically, it's equity in lieu of cash into a transaction. So we can look at your existing portfolio, etc., to see if we don't have to borrow that money, but we can give it as additional security as well. Development versus bridging. Now, they're priced differently. Okay, so if you just want a bridge loan on a house, okay, you're probably looking at anything from 0.59% per month up to 0.95% per month, depending on the lender. If you're looking for refurbishment finance, it usually starts at around 0.95 up. Okay, and there's a very good reason why that is. It's not that they're just trying to take advantage. We're trying to demonstrate to you the risk profile of refurbishment finance, and all interest is priced on risk. So the risk profile on a light refurb, heavy refurb development or heavy development is, when you've got the property, the first thing you're going to start doing is taking out internal walls, perhaps knocking down structural walls, building extensions. Ultimately, the first start of the process devalues the property. And that is where the lender is at its greatest risk. If you take all the internal walls out, run out of money and leave, that security is now worth less than what they initially started or what they've lent you on day one. Okay, and then there's a tipping point as you go through the project where the value normalizes and then actually goes past its original value, etc. Okay, so that's why the lender wants to put a monitoring surveyor in place to make sure that that process happens. Obviously, the scrutiny is a lot less the lighter the refurb, the heavier the refurb, the more scrutiny they're going to apply to that, and also the more expensive the loan is going to be. Okay, so that's a differentiator in the two costs for that. In addition to bridging, well, this is a form of bridging. There is something called a revolving credit facility. It's very popular, so it's known as the old hunter's license. So many people, especially if you want auction purchases, want the confidence that they can go to auction and actually complete on the transaction as a, inverted commas, a cash buyer. What you can potentially do, you can look at your existing portfolio if you've already got property. We can look for an unencumbered property or something that's got a very low loan to value, and we can effectively set up a bridge loan that you don't use. You can effectively set up a bridge loan. It lasts for 12 months, and what you can do, you can draw that down and pay it back as often as you like within that period, which reduces the amount you want to do. So that's really, really good. If you're going to do one deal, it's not worth doing in a 12 months. If you're going to aiming to do multiple transactions in a year, that makes bridging super affordable, because you're not now paying the new legal costs, you're not now paying the new valuation fees, the new arrangement fees, etc., etc. So you're cutting out a big portion of the cost of setting that up. There's one fee at the beginning, and then it'll just roll over and keep going. One thing I would say, if you're going to go and look for these facilities yourself, please keep an eye out for something called a non-utilization fee. Okay, that's where they just charge you a fee whether you're using it or not. There are lenders out there that do not charge non-utilization fees on that. Okay, so keep that. But that's a really good idea if you are looking to do trade properties, flip them really quick and do multiple in a year. That could be a really useful tool for people and keep your costs down significantly. And that's it from me. So I appreciate it was a bit of a whistle-stop tour of anything. Again, welcome any questions in the chat. There will be space for Q&A. Just trying to give you the highlights. There's plenty to think about. And if you're at all concerned, because bridging and development finance can be a daunting topic, then yeah, Gareth will share with you how you can speak with us.
Yeah, thank you, Mark. Just checking you can still hear me. Okay. Yeah, fab. So yeah, obviously, like Mark said, bit of a whistle-stop tour. A lot, if you're an experienced investor already, then some of this may not be new to you, but hopefully you've picked up some nuggets of information there that you can use on your journey going forward. And if you are an experienced investor that has invested in a traditional manner and you've bought properties over time and they've possibly gone up in value and you've never really assessed your portfolio properly, then we're happy to jump on a call and do a portfolio review with you, because you might be equity rich and cash poor and want to do more deals. And what we can do is make sure we can do two things. One, we can make sure your portfolio is optimized to make sure you've got all the best deals available to you currently, and also possibly release some equity from your portfolio to help you go and buy more property, go shopping, as it were. So that's the portfolio review. And then obviously the other one then you could see is book a deal clinic. So if you have a deal that you'd like to discuss with us, whether that be now that you know more about the financing options, you can book a call with one of the team and we can show you your funding options. So that's pretty much it, guys. A little plug from us, but look, ultimately what we're trying to do here is just educate people on how you can really, really grow your portfolio by being quite savvy about the way you go about financing it and the different methods available, really. So I think that's enough from us. I think there was a few questions in the chat, so I will pull those up now. Bear with me. Okay, so first question, I think, was from Jason. Do you want me to just read this out, Jason, or do you want to unmute yourself and ask the question? Maybe I'll just read it out then. So
I'm happy to read it out. Thanks, guys. Really appreciated. Yeah, cash versus kind of a part bridging, part cash arrangement. Would you always say that if you've got cash, always use it? Or is there a model, would you say, that if you were to use part cash, part bridging, maybe purchase a property and use the development on a bridging loan, it would get to you to your financial freedom quicker? Or would you just say recycling the cash is always the winner?
Yeah, so my personal opinion would be it would depend, and the reason being, what is your strategy? What are you going to do? Are you doing one deal at a time? In which case, so if your philosophy is slow and steady, I'm just going to buy one. I've got a pot of cash. I'm going to buy it. I'm going to do it up, recycle it, and then I'm going to go again. And you're only ever going to want to do, because of your time, because of your skills, or you might be remotely investing or whatever. I think if that's your philosophy, then I would suggest use as much of your own cash as you can, because you're going to really get the best margins out of that deal. However, if your philosophy is more aggressive and you say, well, I don't want to do one deal a year for the next 10 years, I want to do 10 deals in the next year,
Yeah.
Because that's some people's attitude, then in that case, you're going to need as much cash as possible. So property, as you're aware, is a very cash intensive game. So I would suggest then you're probably more along the side of use as little of your own cash as possible to do as many deals as you can. I know some people will take the kind of will have a philosophy where they'll keep two, sell one. So they'll do that kind of method. So they'll buy property, the first two they'll renovate, refinance, keep money, and then they'll do a flip. Or they'll do a flip first and then do a refinance to build the pot a little bit and then keep the next two. So it's just understanding, again, having clarity on exactly what you're trying to achieve. And then once you know what that is, then hopefully that will answer the question a little bit better for you.
Thank you for that. Thank you very much. I've got a second one. I just slipped in a second one. That was just really, if you did take a more aggressive route and you took on more loans, or use more finance to support your strategy, would you feel you'd be limited by doing too much, and that would limit how much you could borrow because lenders would see you as risky?
Yeah, good question again, and absolutely, because if you are looking to ramp up, like I said earlier, property is a very cash intensive game, right? So the more money you've got, the more chance you've got of doing more deals or bigger deals. There is going to be a tipping point, and it's hard for me without knowing your background, Jason, around what type of deals you've done in the past. But these are the types of questions that bridgers will ask, because, well, it's not so much the bridgers at this, because bridgers generally will want to lend, right?
Yeah.
What we will be asking you would be, well, okay, you've got this deal on the go. Our key thing is, if we get you a bridging loan, we want to get you off it. We don't want to get you into any sticky situation, right? Because it doesn't help you, it doesn't help us, it's bad for everyone. So what's the exit, and how likely are you to be able to exit? Because having one bridging loan is stressful, because it can get, if you don't do it properly, and if you've never done it before, then don't run into doing 2 or 3 at a time. Whereas if you've used bridging and you're used to doing 10 deals a year, well, maybe having 2 or 3 bridging loans at the same time is not going to be an issue for you. So it's more about going at your own speed. Yeah. I think would be my advice there.
Thank you for that. Appreciate it.
Just to add to that, it's ultimately going to be driven by your experience. If you've got a team and you've got a track record of delivering multiple projects, then a lender is going to be a lot more comfortable if you want to turn up with 3 or 4 on the go. And also it's the scale of the project that you're working on, not necessarily the number. So if you're building 4 houses on a scheme, and then you want to do a conversion to HMO, etc., and you're a small team and it's your second. So also the size of the scheme or the size of the project as much as the number as well, because there's a huge capital risk to the bigger the project. So just to bear that in mind. So it is, depend is always the answer, I think.
Thanks, Mark. Thank you.
Thanks, Jason. I think Sean, again, I can ask a question, or if you want to unmute yourself and ask it, then is Sean still with us? Yeah. So Sean's question then was, in your view, who are the better bridging companies and what are their highlights? Do you use whole of market bridging, or do you only work with specific lenders? Mark, do you want to tackle that?
Yeah, happy to do so. So we have the ability to work with a whole of the market. I don't know how many hundreds of lenders there are. There are also private individuals we work with, and so on and so forth. So we've sort of created our own panel. The reason being is it's an unregulated marketplace, and it can be a little bit like the Wild West if you're not careful, especially with some of the smaller players where they, as I say, they aren't regulated. Some of them kind of make the rules up as they go along as well. So we've done our due diligence on it, and we've sort of created a panel of people that we trust, that we know will fulfill and complete on transactions, which is ultimately what everybody wants. Some lenders, so some of the bits to look out for are going to be where you go through the process and you get to the valuation. As I mentioned, it's an LTV based thing. The valuation is critical in this whole process. You will see lenders that will price it at the front end at, say, I don't know, 0.8% a month, which is competitive in the space. They will get the valuation back. They will tell you that something has cropped up in the valuation, and then they will come back to you and they will say, this has happened, we can still lend, but we're now going to have to price it back up to 1% a month. Well, you're already a few £100 or possibly a few £1,000 into the process at that point, and they've kind of got you stuck. And we know of some lenders that do that as a matter of course. So there are things to just be aware of. It can be a little tricky to navigate that place. If you're going to do it yourself, I would just stick with the household names. I mean, there are banks, there are specialist lenders out there, well known, that do bridging. If you're going to do it yourself, stick with them. They're not going to mess you around to the nth degree, or they certainly don't have a track record of doing it. So that would be my advice with that. Even if they're a little bit more expensive and you think you can get a better deal somewhere else, stick with the beaten path. Don't try and go off a boutique. lender that you've never heard of because they claim to do these LTVs and special rates.
Cool. Thanks, Mark. Florence, thank you for the content. With BRR, as I understand, the development amount has to be a certain percentage of the GDV in order to justify the uplift. Can you elaborate what is the typical percentage, please? Because lender would require to see proof of development funds, and if using the same lender for the STL. Sorry, Florence, I'm not quite with that on sure. Yeah, the short-term loan maybe, is it? Also deposit.
Yeah, short-term loan. Yeah, sorry. Thank you guys, first of all. So I guess my question really is, if you are using the same lender who's going to provide the long-term loan as well as the initial bridge, what I've been told is, let's say, for example, property is worth 200,000 and you're buying it at 25% BMV, so you're buying it at 150, but you know that once you've spent some money on the refurb, the GDV is going to be, say, 250, for example, and the lender would require you to spend a certain amount of money to justify the GDV at 250. So it's a typical percentage, I was told, but I couldn't remember what the percentage was. So just wanted to see if you could maybe clarify that.
So I'm not aware of a percentage. My understanding is that it needs to make sense.
Right.
Because if in that example, if you're buying a property for 150 and it's going to be worth 250, but you've only given it a lick of paint, how are you justifying that uplift in value? So what I think you're referring to in the first instance was like a bridge to let product. There are a couple of companies, just so that everyone else is aware, in case they aren't, there are some companies out there who are the bridging lender, and they are also the long-term lender. And what they will do is the valuer, when you apply for the bridge, the valuer will go out and they will value the property in its current condition, and then they will also value the property. You tell them what works you're going to do, and then they'll value it. If you do those works, they'll give you an end value. And then when the deal is underwritten, they will give you two offers. They'll give you the offer for the purchase, and they'll give you the offer for the long-term mortgage. So what happens is once you ring them up, you do the work, and once you ring them up, they then send the valuer out, and the valuer says, yeah, you've done the work that you said you were going to do. I valued it at what I said I was going to value that originally. Now, so that's a bridge to let product where you're using the same lender. My experience hasn't been brilliant with those types of deals, because again, this is my personal opinion more so, that if you're a valuer and you're actually in the property and it looks rough, that's your first impression. And so when you go back to value it, you've still got this rough first impression in your mind, and you're trying to get a value out of it. Whereas if you've got a valuer that goes there and they see it, but then you've got another valuer that goes there and sees if the first time in a nice done up condition, they haven't really got the same mindset of what it used to look like. So I think if you're not spending much money and you're trying to get a big increase in value, I think using the same valuer is going to be quite challenging. Whereas I think if you've got two different valuers, I think you've got potential to maybe push that value further. I don't know if that answers the question.
Yeah, it's just from what I've known with people who've used the bridge to let product. They were required to provide not only proof of deposit for the initial purchase, but also if they say they're going to spend 30 grand on the development, they've also got to show they've got that 30 grand development funds in the bank as well. So that's quite a lot of money they've got to show in the bank up front.
Yeah, of course, because ultimately, if you're going on to a bridging loan, which is, like we said earlier, is a short-term product, they want to know the one you can afford the deposit and the fees, but also if you're saying it's going to be 50k development, then that you can afford to do that as well. Because if you haven't got the cash now to do the work, they don't really want to lend you the bridging loan, because they're like, well, are you going to be on this bridging loan for a long time? How are you going to fund it? So yeah, that's where the bridge to let product was more designed for your new car light refurb products. Yeah, so your new carpet redecoration, possibly a new kitchen or bathroom type thing, not your full, you know, a 50k refurb is a lot more intense, isn't it, than a quick facelift. So that's what the bridge to let is more used for those lighter refurb products, really.
So in your opinion, then, would you say it's probably better to use a separate bridger to buy the property first, then do the work, and then go on to a different lender altogether? Would you say that would help to avoid?
Yeah, I guess it does depend on the deal, but that is generally my preference for the reason I mentioned earlier regarding the valuers. There aren't many lenders doing a bridge to let product anyway, so it's not like there's a huge amount of options to do it. And the ones that do it, it's quite a narrow criteria, you know, with the light refurb and things. So generally it is, but not always.
Okay.
I just add some rationale to the timescales on that as well. So the bridge to let absolutely is designed for the light refurb stuff more than anything else. Also, you get a very short window on the bridge element. Valuations, the lifespan of a valuation report is 6 months before the lender cannot continue to use it. So they need you in and out of that bridge and onto the mortgage before the valuation becomes expired. So typically, like Precise did it for a little while, 3 months. A lot of the bridge to let lenders that are out there at the moment are actually bridge lenders that have brought in a buy to let product. And the buy to let product, so the other consideration is the long-term loan element of it. Is that actually going to be competitively priced by staying with them? So the 0.5% maybe that you'll save on an arrangement fee, you may end up spending way more than that over the 5-year fixed period of sitting on that loan as well. So invariably it's safer to break it up unless it's particularly vanilla and it's going to run through that process really, really smoothly.
Great. Thank you so much.
Thanks, Florence. Sean asked the question, what is your view of SaaS, and do you work with clients with this pension setup? So we are only mortgage and protection advisors. We deal with specialist finance, so all types of property finance, SaaS included. But we don't help in we're not pension advisors, so we don't help in the setup of SaaS schemes. I've personally not done a huge amount of SaaS lending. It's quite niche, you know, there's not a huge amount out there. We can lend against it. So if it's something that you have and you want to discuss further, then by all means, book a call with us and we can explore that further. Did you have any more specific question on it?
Yeah, thank you, Gareth. Yeah, it's something I'm looking into at the moment. And sorry, obviously I'm aware that you're not a pension specialist or anything, but obviously you still use a lot of people use that more so for commercial, isn't it? It's more so for commercial, albeit there's people out there that are saying that you can use it for residential on loan backs and this, that, and the other. So it's a minefield, and I've got a real dilemma with it because the disparity of communication around it is just ridiculous. And also not only that, but and I know it's not under your field, but the specialists or so-called specialists that are providing this SaaS, the differential in expense is unbelievable, absolutely unbelievable. And I think for the layman, it's very difficult to derive what the best thing is to do around SaaS.
Yeah, so I've got a little bit of experience with it. I went to a SaaS just because I was interested more so than anything, a SaaS networking event. And the guy, I was actually from my hometown, and he was saying, yeah, I've transferred my pension into a SaaS and I bought this building. I was like, okay, what's the building? It's a block of 8 flats, residential. I was like, okay, that's interesting. How did you manage that? He said, oh, I've done it through this thing called GDQL, Genuine Diverse Investment Vehicle. Something to that description. I forget the exact wording. And I said, okay, that's interesting. I didn't realize you could do that. You know, you're purely, there's no in-between structure. It's just genuine diverse investment vehicle. So I went around the room and I spoke to some of the people that I knew who were well-versed in SaaS. And everyone I asked was like, nah,
Can't do it, no.
can't do it, can't do it, can't do it.
Sure.
Then he said, oh, but I was advised this by a well-known person on the circuit or whatever. So I just thought it was quite interesting. So I did a little bit of research, not a huge amount, but the one thing I did find out that, and don't quote me on this, but if HMRC figure out that you are investing incorrectly, they will tax you 70% of your pension pot.
Yeah, I've been told 40%. But yeah, it's a lot of
More,
money, even
more
40.
than 40. So you're really, you're risking your life savings. I just don't personally. I'm not saying it's not a good vehicle, because absolutely it is. Done in the right way. So I would say stick to commercial. You can get some. I think now, if your money's in the SaaS already, I think now is a good time to buy some commercial property. There's potentially some deals available. I think with the change now in the market, we're expecting with the capital gains tax change coming in potentially in the next autumn budget. I think there'll be some landlords trying to offload some properties. So maybe some in the commercial space could be quite a good spot at the moment if you've got funds ready to go. But I wouldn't personally risk that. I know you can do, buy land and get planning gains. You can do stuff. Development is, again, because how do you get it? You can't have a residential element. So I think it's as soon as they connect the water or something like that is when it classed as practical completion. But how do you get from practical completion to get the loan paid back? So there are opportunities for sure. I see some of those deals. I think just buying good, solid commercial properties to hold for long term. I think that's possibly what I would be looking, and maybe like converting a commercial into like a multi-let commercial offices or something like that. I see that as quite a good space at the moment.
Is so I've run into a couple of these where people have used. So the one piece of advice would be, and I know that the people on the circuit will tell you to become your own trustee. I think that's just a dangerous piece of advice. You don't know the legislation. You're not a professional trustee. Find a professional trustee that understands what you're trying to do, and they will guide you through the process. They're there as a safety net. So that's one of the things. In regards to that, dealt with exactly that case where somebody was allowed, with the trustees' consent, by the way, all perfectly legitimate, to build the house to use the funds within the SaaS to build the house. It was a barn conversion, which they were allowed to do. The trustees were enabling them to do it. However, they could not get builder control sign-off because they made it residential. So they had to get a bridge loan to buy it off themselves, to then take it into their personal names to get builder control sign-off so that they could then subsequently go and get a mortgage. So just get some good trustees involved, basically, is the plan. It's really untidy, and there is a lot, as you say, a lot of miscommunication, a lot of bad advice going around.
Absolutely.
People have been on these courses and whatnot.
Yeah, it's great. Thank you.
Thanks for the question, Sean. I think Michael just asked the question regarding why is bridging not regulated. So in the UK, the regulated mortgages are your residential property, your home, anything or a property that you've got a family member living in or that you've used to live in, and maybe you rent it out. So if you become an accidental landlord, so say you lived in a property and then you bought something else, that's classed as a consumer buy-to-let, which is also regulated. If you've inherited a property and your family's members lived in there, that you're an accidental landlord, that would be classed as in consumer buy-to-let also. So basically anything that you will to live in as a main residence would be classed as a regulated loan. And then everything else is, so your standard buy-to-let, your bridging, your commercial, everything else is unregulated. What that means is it's just the protection that you're afforded by the FCA around various bits of protection. But you have to be a regulated lender to lend on a residential property, which is where you'll see a lot of bridgers you might see that we don't do any regulated loans. But
Okay, thank you very much.
with a lack of regulation comes,
Downwards.
yeah.
Thank you.
Welcome. Anyone else got any questions? I think that's it from the chat box. Has anybody got anything that they'd like to ask about any of the content tonight, or something else outside of that, you know, from a finance perspective? No? Okay. Well, listen, guys, thanks very much for attending. Thanks for your time. Appreciate we've probably gone over a little bit on timings, but hopefully it's been useful. And yeah, if you need anything, just get in touch, and we'll see you soon.